First, I would like to thank the organizers for those including the paper in the program. Now that I know there are 200 papers, I feel very lucky to be here. I also would like to thank our discussant for the comments to come and presenting how abundant are reserves, evidence from the wholesale payment system. This is joint work with Darrell Duffie and Lorenzo Rigon and Stanford University, and with Hyun and Shin at the Bank for International Settlements. Before I begin, let me just say that these are my views, and they don't necessarily reflect those of the Federal Reserve System, the Federal Reserve Bank of New York, or the Bank for International Settlements. Across many jurisdictions, central banks are engaging in a process of policy normalization. They are removing policy accommodation, they are tightening rates, and reducing the size of the balance sheets. The key question at this time is that of reserve adequacy. The level of reserves in the banking system needed for the implementation of monetary policy, the smooth functioning of money markets, and of the financial system more broadly. In this paper, we're going to look at this question through the lens of the payment system. Prior to the global financial crisis of 2008, banks across many jurisdictions held very low level of reserve balances relative to the dollar value of the payments that they processed. They have to rely heavily on incoming funds to make their payments. So this reliance on incoming funds to process outgoing payments generates a high degree of a strategic complementarity, by which a bank's willingness to send out payment is going to be greater if other banks do so too. Since 2008, many central banks have expanded these balance sheets to provide support to the economy and to promote the stability of financial markets. And as a result, the reserves that banks hold in their accounts at the central bank have increased starkly. The question we want to ask in this paper is this a strategic complementarity that has been documented in the past still exists in an environment of elevated reserves. And why should we care? Well, first, the existence of a strategic complementarities opens the door to potential Greek law scenarios that potentially can't affect disruptions to payment systems and poses a vulnerability to the financial system. But second, the existence of these strategic complementarities suggests that banks view their reserve balances intraday and act as if it were a scarce resource, even in an environment with elevated reserves. Briefly show you the roadmap. First, I'll describe the data that we use. I will very briefly present our main specification and results. I will touch on some of the robustness with a lot of in the paper, and I will try to wrap up on time. In this paper, we use two sources of data, of confidential data. First, we're going to have information on payments. We're also going to have information on reserve balances. Let me start with payments. We have information on every transaction sent and received by any participant on Fedwire Fund Services. Fedwire Fund Services is a large value payment system in the US. It's owned and operated by the Federal Reserve, and is what we call a real-time gross settlement system. What this means is that transactions have to be processed on an individual basis. There's no netting of transactions. And this is going to be important for some of the dynamics we're going to see later. On an average day in 2020, the payment system processed around 700,000 transactions with a dollar value of roughly 3.3 trillion. Fedwire is open for 21.5 hours during our sample period. It opens at 9 p.m. on the preceding calendar day, opened overnight through the day, and it's going to close at 6:30 Eastern time. On March 2021, the operating hours were extended to 22 hours. I closed at 7 p.m., but that's going to be outside our sample. First, we're going to look at the first 100 days in 2020, and then we're going to take a step back, extend our analysis, and see if our relationship still holds over a longer period, from 2010 to 2020. We have information at the transaction level, but for this analysis, we're going to aggregate up to minute-by-minute level. So for every minute in a business day, in our sample, we have the information on the payments that a bank received from all its counterparties and the payments that it's going to make. There are more than 5,000 participants on February. We're going to focus on what we call banks, which requires excluding some entities, for example, the account that the Treasury Department has with the central bank. Payments are 5,000 entities. The top 100 are responsible for roughly 90% of the dollar value. So we're going to focus on the top 100 institutions. Even within this 100 institutions, the top 15 are responsible for 3/4 of the total volume. The second data set is a data set on reserve balances. So this is registered of the Federal Reserve, where for each depositor institution, we have information of the balances that they hold at the end of the day. In the analysis, we use opening balances. We're going to proxy the opening balances today by the closing balance yesterday. Reserves are also concentrated. And the largest entities that we identify by the dollar value of payments, those top 15 hold 40% of the reserves in the banking system. So in this paper, our goal is to understand the relative scarcity or abundance of reserve balances. To do so, we're going to look into the US, into the payment system, and we're going to ask the question if strategic complementarities still exist in environments of elevated reserves. We're going to focus on 2010, and we're going to narrow into the relationship between the payments that a bank makes and the payments received over the past 15 minutes. Before I show you our baseline specification, let me just highlight two features of the data that are going to influence our modeling choices. The first one is related to the intraday dynamics in the payment system. Because of the nature of the payment system, because transactions occurred they get produced, in real time as a gross settlement system, we see that there's traditionally very low activity overnight and a high concentration of payments at the end of the day. So we're going to control for some of that. And then second, in our sample, we have minutes when payments take no value, what we call the zero payments, when banks don't send or receive any value. But then there are going to be minutes when banks and the value of the payments are going to take off a wide range of values. So a linear or a log linear relationship might not be well suited to capture the relationship between the payments that a bank receives and the payments that it makes. For this reason, we're going to estimate a Tobit regression. And let me show you the baseline specification. We're trying to get the simplest model that can capture the relationship between the payments that a bank makes and the payments that it received. Maybe I can move. So it's going to be the payment that bank I on minute M of the AT as a function of the payments that this bank receives from all its counterparties in the previous 15 minutes on the AT. All our specifications are going to have bank, date, and period of the day fixed effects. And we're going to classify standard errors at the bank level. Let me show you our main result. So our result shows the relationship between the payments that a large bank makes over the next minute as a function of the receipts in the past 15 minutes. The coefficient estimate is roughly 0.6 with a standard error of 0.18. It's positive and statistically different from 0. Since we're estimating a Tobit model, we cannot interpret that coefficient as the marginal effect of an increase in the cumulative receipts. To do that, we need to adjust the coefficient, and when we show in the second column, shows the marginal effect of increasing. So what it's telling us is a 1% increase in the cumulative receipts that this bank gets over the past 15 minutes leads to a 0.4% increase in the payments that that bank is going to make over the next minute. And we find this in 2010, when reserves in the US banking system were in excess of 2.5 trillion. So if we take a step back, these results are suggesting that there is a strategic complementarity in payments, even in environments of elevated reserves. estimating strategic complementarities directly is typically quite challenging because there are concerns about omitted variables. So in the paper, we do a long list of robustness checks. So I'm going to just point to some of them. So first, all our specifications are going to have bank, date, and period of the day fixed effects. And the idea is that we're going to try to capture any unobserved variability that is, for example, constant across day and period of the day by changes across banks. Then we're going to do a series of robustness analysis where we're going to explicitly control for variables that we think may affect our relationship. For instance, we could think that opening balances in the banking system or for that bank in particular may affect the relationship between how a bank pays relative to how much gets paid. Suppose that a bank has a very large balance at the beginning of the day, it may need to rely less on the incoming funds to process their payments. So we're going to control explicitly for that in our regressions, and we'll see the results still are almost unchanged. Payments, the next set of robustness are going to look at payments dynamics. It's possible that where we capture is some persistency in payments. We know that payments are persistent. It may be that it's not a strategic complementarity. So we do several robustness checks where we control explicitly for payments, both say the payment in the past minute, cumulative payments in the day, and we run our specification. So payments are persistent and they have explanatory variable, but our result holds even after controlling for payment dynamics within the day. So, and finally, there's a third set of robustness that we do. And in some way, I personally find this one a bit more appealing, is the idea that we're going to look at differences in the strength of this strategic complementarity. We hypothesize that when the banking system has higher reserves, the relationship should be weak. And when we are draining reserves, the relationship should be stronger. So we do a series of robustness tests where we now interact our slope, our relationship of interest, the relationship between how much you pay out, given how much you receive, with the level of balances in the banking system, reserves, or reserves that the banks hold. And let me just, oops. Oh dear, there. Just focus just on the last one. What we see here is we're interacting the slope of our relationship with the level of reserves when the banking system opens that day. And what we see is, well, the relationship still exists, but the magnitude of the effect on days where the banking system opens with higher reserve relative to low reserve is smaller. So on days when the banking system opens with low reserves, the strength of this relationship is higher. The next question that we want to ask, are the dynamics intraday different? To do that, we're going to do a series of regression analysis, but this chart summarizes some of the main ideas. We're plotting here the share of payments by time of the day. This is on the first 100 days of 2020. And we're going to plot it for days when the banking system opens with high reserves and the days when the banking system opens with low reserves. High is for the blue, the dash red corresponds to the low. So what we see here is that, and high and low are represented by the highest and the lowest deciles of the distribution of payments, of reserves, sorry. So on days where the banking system opens with low reserves, the share of payments that gets sent later in the day is higher. So when the banking system opens with low reserves, the strength of this relationship is high, and banks are going to push the payments later in the day. Why? Because they are economizing on liquidity, and I'm trying to take advantage of the potential netting of payments. Because the US payment system, you have to process every payment through. If we were able to send the payments closer together, it's as if we were netting. We do the same using some regression analysis. What we're going to do is we're going to look at the relationship between the share of receipts and the balances in the banking system. We're going to divide the day in periods of 20 minutes. And for every 20 minutes, I'm going to run a regression and see what happens on the share of payments when the banking system opens with high or low reserves. Our coefficient of interest is beta 1, and it's plotted here. Solid blue corresponds to a coefficient regression. So this is outputting, this is like a long list of regressions that we're going to input, we're going to export in this chart. A solid blue coefficient is showing a coefficient that is positive and statistically different from 0. Red is negative and statistically different from 0. Gray are not statistically different. So it's the same idea. When the banking system opens with lower reserve balances, when B is lower, the share of payments that gets sent later in the day is higher. So the next question that we do in the paper is to ask, is this just a fluke of 2020? It was rather an unusual year for all of us, or is this a relationship that has persisted over time? So I'm going to take a step back, expand our sample. We start in 2010 to 2020, 11 years of data, and we ask 2 questions. The first one is, how does the relationship between what a bank pays related to how the bank receives evolves over time? Is it there? The second one, are there changes in the intraday dynamics? So I'm going to summarize our results. In this graph, we're going to run our TOBIT analysis every quarter from 2010 to 2020. I'm going to plot the coefficient of that regression to the blue line. The red indicates the level of reserves that these top largest banks held at the time. So what we see is that as the Federal Reserve expanded the balance sheet, and as a result, reserves grew, the strength of this relationship decreases. When we normalized and the level of reserves declined, the strength of the relationship increased. So the next question is similar to what we asked before. Do we see differences intraday? We create a similar chart as before. This is the share of payments throughout the day. Now we have 11 years of data. And we're going to plot the share of payments by time of the day on days where the balances are high and when the balances are low. This case is even more stark. If we look at the dashed red line, what we see is that when the banking system opens with low reserves, the share of payments sent late in the day is much higher. And this is consistent with the idea that banks are economizing and optimizing on their intraday balances management. We do the same with regressions. I'm going to skip that to make sure I finish on time. And let me just conclude. So in this paper, we're interested in understanding the relative scarcity of abundance of reserve balances in the US. We focus in the US, we look at the payment system, and we want to ask the question of the existence of strategic complementarities in environments of elevated reserves. We find that a 1% increase in the cumulative receipts that banks get over the previous 15 minutes leads to a 0.4% increase in the payments that that bank is going to make over the next minute. This result holds in 2010 and throughout the sample in environments where reserves were at least 2.5 trillion. So we find that in an environment with elevated reserve, there seems to exist a strategic complementarity in payments. We see that this relationship is stronger when reserves are lower, and that the share of payment that get pushed in the late is higher.
All right, I'd like to start by thanking the organizer for inviting me to discuss this very interesting paper. I think this is a very interesting topic. We have like a lot of several developments in the functioning of the money market post-Great Financial Crisis, and I think this paper is inserted in many things I have been learning recently about how banks operate recently. So this basically is triggered by the unprecedented expansion of the central bank's balance sheet. Banks amass an incredible amount of excess reserves. This forced central bank to change its operational procedure and the way that monetary policy is implemented to deal with the fact that we live now in a world with abundant reserves. So at least that's what we thought, right? So we imagine that we're living in a world of abundant reserves, but we start to get more and more signs that actually reserves may be scarce, even though reserves right now are much, much higher than were prior to the Great Financial Crisis, right? So what this paper do is to look at this question of how abundant or how scarce reserves are from the point of view of the payment system, which I think is new to this literature. So what instead of looking what happened, let's say, to repo rates as others did, they're going to look directly at the payment behavior of banks, and they document this strategic complementarity, this idea that banks are more likely to send payments after they receive payments from others. So that's basically the idea, and they have this estimate that a 1% increase in receipts in the last 15 minutes increase the payment by 0.4% on the next minute. Okay, so basically what we're going to try to do is to put this a little bit in context and discuss some of these transformations that we witnessed in the recent decade, and then try to discuss some of the interpretation of the results and discuss a little bit of the econometrics at the end. Okay, so this is the world that we used to live prior to the great financial crisis, right? So the figure I want you to look is this scale. So how many reserves do we have? Like, well, $2 billion, right? That's basically the amount of excess reserves. So the idea is reserves are costly to banks. They're going to try to economize on it. We'll try to keep like a small amount of excess reserves. How much did they change after the great financial crisis? Well, we cannot see it anymore, right? So the idea this is now trillions of dollars that we have of reserves. So you can see here the massive expansion of the central bank's balance sheet to reflect that this increasing reserves. You can see the normalization happening and expansion again after 2020. This led to a change in the way that we think about how to implement monetary policy. We used to think, like, okay, the way that the interest rate is controlled is by changing the quantity of reserves. Reserves are scarce, and if you expand the amount of reserves in the system, they're going to push the interest rate down. If you want to increase interest rate, you have to reduce the amount. But during the zero rebound, we expand the amount of reserves until we get to the point where the demand for reserves are flat, and we get to the zero rebound. And then we want to lift. We had to change the operational procedure. So that's we introduced the interest of excess reserves, right? So what usually in textbook versions, you'd expect this to be a floor interest rates, but here in the US, it's like a leaky floor where actually rates go below the interest excess reserve. So that's why we have the overnight reverse repo facility, where expand the access to parking your money at the central bank beyond depository institutions. And again, this were done because we were living now in a world of abundant reserves, really the flat part of the curve there. Okay. However, start to get signals that this is not actually as true as we thought. So what we're seeing here in blue is the amount of reserves for larger banks, and in red is the general collateral repo rate over the interest of excess reserves. And what you can see is these spikes. So the interesting thing about this are the spikes. So notice that we have this periodically, like in particular over quarter end periods, we have these spikes, and then we have something massive happening right during this period, in particular in September of 19, right? So where this repo interest excess reserve spread went to over to basically 400 basis points. And the question is, how come, right? How come banks that are like basically swimming in liquidity, we have like this trillions of dollars of reserves, how much they how come they didn't explore that by lending and arbitraging that away, right? So this caught, I think, everyone by surprise. That this is from the Fed, like the idea that the expectation had been that as repo rates rose, banks would withdraw excess cash held at the Fed and lend it into the repo market. Instead, the New York Fed had to step in and to provide that cash as banks remain on the sidelines, right? So why did the banks remain on the sidelines? Well, this is a very nice quote by Jamie Dimon from JP Morgan. Say, oh, look, we have $120 billion in your checking account at the Fed. It goes down to 60 billion and then back to 120 billion during the average day. But we believe the requirement under the new liquidity regulation that we need enough that net accounts, and that in extreme stress during the course of the day, it doesn't go below zero. If you go back to before the crisis, you'd go below zero all the time during the day. So the question is, how hard is that as a red line? So this idea that this intraday liquidity regulations going to have play a role, right? So why we're seeing this different behavior compared to the previous period? Well, because of the regulation is different. So that's perhaps the main understanding here. We have like a range of new regulations on the Basel III, capital regulation, like the supplementary leverage ratio, the liquidity regulation. It's liquidity coverage ratio, and importantly for our story, the liquidity stress test. The idea that banks must have enough liquidity to cover like the one-day outflows. And interesting enough, like this, we have like recent work connecting this intraday liquidity shortages with the repo spikes. This very interesting work by Copeland, Duffie, and Young that basically shows this connection between the intraday liquidity and the repo spikes. And Adrian Davenas and Quentin van der Velde held this incredible model that tries to capture this mechanism. Very, very nice work as well. So the way that I see the paper, it basically comes in this wave of trying to understand what this, how come this liquidity is costly in a world with trillions of dollars of reserves. Most of this work looked at the repo spikes. Here we're going to look directly into payments, and they're going to document this strategic complementarity, right? So the liquidity was costly. We didn't expect banks to wait for the money to come from others to send it. You're just going to send it whenever. But here you see this relationship. So the first main comment is how exactly to think about this, right? So in particular, I think this is very surprising if you're not expecting liquidity to be scarce intraday. But in light of this recent work, like, is this confirming the same ideas that we had before, but look into a different angle, which is nice. And I think it's good to have confirmation when you look at the different aspects. But is there something new and specific that this is strategic complementary showing that previous work was actually not showing? So this, I think, would be very helpful to me. Another thing is some help with interpret the magnitude of the effect as well. It doesn't seem like small effect at all, but like can you give like some context? How do you think about the great financial crisis periods? One thing that's different, perhaps, like the Fed could be more active than the pre-period. This daylight overdrafts was like play a more important role there. How do you think? And what exactly like strategic complementarity tells us, right? Why is this like very interesting statistic to look at, right? So does it move with the cost of liquidity? Should expect that, right? So or at the end, like, you'd also say, like, okay, as long as the cost is epsilon, yeah, I'm gonna wait to get some money and then send it, but this doesn't have like much consequence. I think some of your results, I think, show it otherwise, especially when in fact they're reacting when the reserves change. I think that's quite interesting. But I think some discussion of that is also quite nice. This is probably one of the nicest plot that I like it in the paper. This connection between reserves and the reaction. And one thing that struck me is maybe you can think this is almost like an early indicator. Like, so there's like a huge increase in this coefficient over time, way before we start seeing these spikes in repo rates. So perhaps if you start seeing this thing going up again, maybe we should be worried that, okay, maybe there's something going on. And this is, I think, this maybe one avenue of helping you distinguish what's going on in the repo markets. Maybe waiting to see this appearing in the repo, maybe too late, and starting to look, well, banks are now starting to wait more for money to come in before sending. May be like a better way to gauge like how costly this liquidity has become. So the third comment is very quickly about the econometrics of this. This thing has lots of zeros, so that's basically a problem. A typical solution is like log 1 plus transformation. That's actually a very bad idea, and we know this from the literature. The authors are actually very careful and do it a little bit. My recommendation is, one, they retain the log 1 plus. I'm not quite sure why. I don't think that helps that much. And also the literature has suggested using like some Poisson regressions in the settings. Quite surprising because this is like count data, but it actually is quite helpful for continuous variables as well. Very interesting paper. I think a very important topic that we actually have to need a lot more work on. Okay, thank you very much.
So thank you so much. It's a pleasure to be here. My co-authors and I are eager to get your comments on this paper. It's weird to be in this room. I actually did my PhD here, and I think I failed a few classes in this room as well. So it is so strange. So the paper is focused. So after the crisis, as you all know, there's been an explosion of macro tools. And there's also been changes in the way central banks conduct their policies. And so what we're focused on in this paper is we're trying to understand whether there's a connection between certain kinds of macroprudential tools and the effectiveness of quantitative easing. And in particular, the effectiveness of QE in increasing the availability of bank credit to firms. So that's the big question that we're trying to get at. The particular macro tools that we're thinking about is historical cost accounting and mark-to-market accounting. And there's been a lot of work done thinking about this particular question. I know in the US, the debate over MMA and HCA began after the savings and loans crisis in the early 90s. So there's a bunch of work on this. And the QE program that we're looking at is the ECB's PSPP program that was launched in 2015. And the big exercise that we're thinking of is we're not necessarily focused on the traditional debate of whether HCA leads to more stable banks and so forth. What we're asking is whether the choice at which you value government assets on the balance sheet, whether that affects the pass-through of QE. So in the most basic world, for example, you think of bank capital as a residual on the balance sheet. And here I've purposely, so this is the value of government debt. There's been an explosion of government debt on the balance sheet of banks after 2010. I've purposely put the question mark here because that's central to if you're using HCA or mark-to-market. And so this is the setup. And then if you allow for the standard exercise, you have that equation, and then you have the regulatory capital constraint equation. When you combine those two equations, you get the basic fact that the net worth of the bank is proportional to the lending capacity of the banking system. Okay, and then the traditional debate over HCA and MMA is that if you're using HCA, then you're fixing the value of government debt at historical cost, and you're insulating the balance sheet from fluctuations in government debt prices. And the theory behind this is by doing that insulation, by protecting the balance sheet from fluctuations in government prices, you're able to preserve the lending capacity of the banking system. Okay, and there's been, of course, a big debate about this now as well. And the debate is the perverse consequences. Investors don't gain transparency into the banks because the prices are held at cost. After the savings and loans crisis in the United States, the argument was HCA creates this gains trading where banks have this perverse incentive to sell the highly appreciated assets and keep the losses, which makes things worse. So this is the big the trade-off here. Where we're going in our paper is we're arguing that potentially historical cost accounting could interfere with the transmission of QE. And the argument that we're making is one of the mechanisms that we think QE works, and this is still, lots of work is still being done here, is the recapitalization channel. The idea that when the central bank steps in and buys the government assets, it increases the price of these assets, and then it augments the lending capacity of banks. And so the simple idea that we have is if the recapitalization channel is the salient channel for QE, if you value the assets at historical cost, then although the market price of the assets might go up because the government has stepped in to buy them, it doesn't pass through onto the balance sheet of banks, and so it interferes with the transmission of QE via this particular mechanism. Okay, so that's the question. I want to argue that the question is an ambiguous one because we're still trying to isolate and parse out what the mechanisms are for QE, and there's ongoing work that argues that the recapitalization channel mightn't be central. It might be the signaling channel, meaning if a central bank commits to large-scale purchases, it sends a signal that rates are going to be low for a long time. It takes away the uncertainty, and so that could be the channel. The alternative channel that people have talked about is the liquidity channel. That is, if the central bank stands to be the large buyer of these assets, it makes it easier for banks to rebalance their portfolio. You could now sell these bonds, not dislocate the price, and make loans. In that instance as well, the importance of HCA or MMA might not be as big, okay? And then of course, the argument as well is QE could change risk premium. And so that might also make it easier for banks to raise capital and then lend more. That channel is also independent of the HCA story. So it's possible, but not necessarily, it may not be the case. It's also hard to test in practice. I mean, you guys have all done work on this. We know that QE is a highly endogenous kind of policy. It tends to come when things are bad. And so it becomes very difficult to disentangle the supply effects of QE from the demand side story. When the ECB launched the PSPP, there was also a bunch of additional programs going on at the same time. So it again becomes very difficult to disentangle if you're picking up the effects of the PSPP versus the other stuff that's ongoing at the same time. And then, of course, just to talk, I'm going to spend some time on this, but just to give you the signal, to measure effectively the role of accounting, because different assets are held, well, I phrase that badly, because the same asset can be held at different parts on the balance sheet and treated differently. You have to have pretty micro data to measure the exposure of QE via these kinds of accounting channels. And so in our paper, so just to give you, I mean, you all know this, but just in case, what we're exploiting is that if you have a sovereign asset or a private asset and you intend to hold it, then the typical accounting is cost accounting. If it's a private asset and you signal it's available for sale, typically it's mark-to-market accounting. If it's a private asset or sovereign in the trading book, it's mark-to-market as well. The experiment that we're exploiting is sovereign assets that were available for sale during the diabolical loop in the EU in 2010. The rules on this varied. And so for a lot of the sample, the ECB classified this at cost. Okay, and then after the PSPP ended and things calmed down, they moved to mark-to-market accounting. And then there was a resumption of the PSPP, and that's the difference that we're trying to exploit in this paper. So I said that in words. I'm just going to pause. You could see it in the picture as well. Okay, so this is the change that we're trying to take advantage of. And you could see it one more time. During COVID, they went back to cost accounting on the sovereign assets. Okay, so what we're exploiting, again, just to be completely clear, is the variation that takes place here. Okay. And so the empirical specification that we have, and why I put the word monthly there, is a couple of empirical challenges. Is we want to be able to tell apart the effects of the PSPP from something else. And so by using monthly data, we could identify the precise month when the ECB announces this program, and that helps us to rule out the competing stories. The way we're going to try to do this is we're going to measure for each bank in Italian data, we're going to measure that bank's exposure to the PSPP. By exposure, what we mean is the assets that the bank is holding that's eligible for purchase by the ECB, with the thinking being that if the ECB is coming to buy sovereign debt, it's going to push up the price of that debt, and banks that hold a lot of that debt are then going to benefit by seeing their net worth going up. That's the intuition. I said that what we're concerned about, if we want to make a causal statement, we need to be concerned about whether the other programs that are ongoing are going to contaminate the exercise. So I'm not going to go into all the details in the short time we have, but we try to control for a lot of the other policies as well. We also try to control for other aspects of the balance sheet of the banks. The thing that I think gives us the most traction, but I'll let you be the judge of this, is we're doing this at the firm, year, month level, so we can do things like a firm by month fixed effects. So effectively, the experiment would be taking a firm that's borrowing from two different banks. These two different banks are differentially exposed to QE within that month. And then we could study how, if there's any lending difference across these two banks, then it makes it more plausible that this is a causal statement coming from the supply of credit and not from the demand side. That's the exercise here. The main takeaway is, so there's been a big literature looking at QE, and so we're following those papers. The takeaway I want you to get is, if you don't distinguish the accounting treatment and you just put all of the assets that's exposed on the right-hand side as a measure of exposure, you're unable to detect any significant effect of the PSPP. There's a pre-trend here, as you could see, and there's a post-trend. Okay, then if you conduct the experiment of saying, I'm going to measure exposure now slightly differently. I'm going to measure exposure based on whether those assets are mark-to-market accounting, right? So whether the valuation changes can pass through. In those instances, what you find is, in the month of the 2019 PSPP, there's almost an immediate surge in lending, measured based on those banks that are exposed to the PSPP via mark-to-market accounting, and the effects is reasonably sizable. It's about 12.1 billion euros. In the Italian economy, that's about 0.007 percentage points of GDP, which is pretty big to occur in just a couple of months. Okay, so it connects to the literature on QE by saying there is a potential causal effect of these programs on getting banks to lend to firms. Now, I'll just briefly give a list of some of the checks that we do. You might be concerned that mark-to-market accounting measure that we're using is proxying for cost accounting. So what we do is we run a horse race in the following way. We say we're going to measure exposure based on mark-to-market accounting and also measure exposure based on cost accounting at the same time. Okay, those assets that are classified at cost, we'll put that in, and we'll run the same difference in difference horse race and see whether there are any changes in the mark-to-market accounting specification in the coefficients. And I'm not showing you the historical cost specifications here as well. The takeaway is it doesn't change. Okay. Then the benchmark specification attempts to deal with the outliers. We use a dummy, and the findings are about the same. The economic magnitudes are also about the same. We repeat this experiment for the 2015 version of the PSPP. The key thing here is, in the 2015 version of the PSPP, most of the sovereign assets were available for sale, and they were mostly classified at cost, okay, or all were classified at cost. And so what we find is, if you don't distinguish between the accounting classification, you're unable to detect an effect of the PSPP, okay, as you saw in 2019 as well. However, when you disaggregate or distinguish between the accounting classifications, mark-to-market exposure almost immediately in the month of the PSPP leads to this surge, or is associated with, to use more cautious language, is associated with this surge in bank lending. Okay. Then if you follow the same exercise and try to rule out if it's coming from the cost side, historical cost exposure, it does not. And then we conduct the same experiments as you saw. The takeaway, which does not seem to show up here, I'll just pause for a second. The takeaway is that in 2019, the PSPP was associated with about a 12 billion euro increase in lending. In 2015, the magnitudes are about 50 times smaller. So it's a bit of point, it's a 250 million euro change. And that's coming about because of the fact that most of the assets that the ECB was buying in 2015 was valued at cost. Okay, so that raises the prospect that the macroprudential accounting regime in place could be interfering with the transmission of QE onto bank lending. You might be concerned about anticipatory bias. The PSPP announcement wasn't a shock in many cases. Banks could anticipate this. A couple of factors weigh against that. Bank exposure tends to be pretty sticky. And if you instrument bank exposure with exposure like a year prior, the point estimates also stay the same. So that weighs against the anticipatory story. In our specifications, we control for the list of ECB policies that were ongoing at that point as well. The findings don't change a whole lot or don't change at all. We also control for other features of the balance sheets of banks. The findings don't change. You might be concerned that what we're picking up, since we're using a narrow one-year window around our specification, we might be picking up an artificial counterfactual driven by a seasonal demand in credit. And so what we do is we expand the specification to about 55 million firm month points. And so the counterfactual is much broader. It allows us to control for some of the changes in the demand for credit in the Italian economy. The findings don't change a whole lot as well. If you conduct the experiments 1 year earlier, you don't find these things. So it's not just an artifact of the timing. It's not a seasonal story. Then to weigh against the demand interpretation, we have data on interest rates. And so if you run these specifications with interest rates on the left-hand side, what you find is that interest rates decline, and that would be counter to the demand story. If it's a demand story, the quantity would go up and the price would rise as well. In this instance, more exposed banks lend at lower rates, not higher rates. We also conduct this at the extensive margin, and we find that these findings also hold. Extensive margin being that firms are more likely to get credit for the first time for more exposed banks. So these are some of the checks that we do. I motivated this talk by saying that cost accounting might interfere with the transmission of QE if we think the recapitalization channel is a salient channel here, right? So there's a way to then test this mechanism. We then go back and ask, if the recapitalization channel is a salient channel, then these effects should be a lot weaker for the banks that are better capitalized. And so this tells us if we include an interaction term for capital and for the liquidity of these banks, a lot of the action should be coming on capital. And so we do find that the point estimates are significantly smaller for the more capitalized banks. Okay, so that's consistent with the mechanism that we have in mind. So I think I can try to summarize the findings. I mean, one, it's non-experimental, so we always have to be cautious in the way we interpret these things, but I think it seems to be plausible that the choice of accounting does or might seem to matter for the transmission of QE. And in particular, again, there's a potential trade-off that if you use HCA accounting in the short run, you might preserve the stability of the banks. But if other policies are ongoing at the same time that are trying to foster economic growth and HCA stymies those kinds of policies, then you get the stability in the short run, but it could weaken the banks in the medium and longer term. What we don't know, so I want to be candid about some of the things we don't know here. We don't know if this works for quantitative tightening. It would be interesting to study if you ran this the other way in 2017 and 18, if you find the opposite. Also, what we don't know is if how this works for conventional stuff, if this also matters for changes in the policy rate. I think those kinds of papers are still to be done. And if you are a theorist, I don't have those skills, my co-authors have those skills. I think it's interesting to think of models that try to say, if you take this paper as credible, then is there a way to sort of combine the benefits of HCA? And one way to do that would be to use mark-to-market accounting, but vary the capital requirements so when things are bad. So you get the pass-through. My co-authors also had this clever thought, which I don't take the credit for, is you could also have a hybrid mix. You could say you're going to have historical cost accounting for the sovereign spread at the time the bank buys the asset, but pass through the risk-free rate. So that gives you, again, the best of both worlds. So with that, I'll stop.
The debate about historical cost accounting versus mark-to-market is rather old. And recently, the default of Silicon Valley Bank brought this debate back into attention. You can see, for example, the Financial Times had this headline: fair value approach would make the SVB losses on bond portfolio obvious to investors. And then the Institute for Chartered Financial Accountants was pushing a lot for a mark-to-market approach. And a recent Vox EU column by Admati, Helving and Portes push a lot, again, about adopting mark-to-market for all bank assets. But actually, I'm old enough to remember the debate following the global financial crisis. And the key argument there was that mark-to-market accounting could increase financial sector procyclicality. And if you like, to go back to the terms of that debate, I can suggest to take a look at an occasional paper by the Bank of Italy, by Panetta, Angelini, and co-authors that set the stage about the pros and cons. So this paper fits very nicely, I think, into this debate because it shows how the accounting regime for the valuation of assets in bank portfolio, so historical cost versus mark-to-market, impacts the transmission of unconventional, in this case, monetary policy. It uses a very rich micro data set on the individual loans from the Italian credit register. And the main findings are that banks with a larger share of mark-to-market assets relative to banks with a larger share of assets at historical cost lend relatively more after the public sector purchase program announcement. They apply lower rates to borrowers and also are more likely to accept loan applications. So there are effects on the intensive margin, the extensive margin on prices. And then there is an interesting proposal of a mixed accounting regime to try retaining the benefit of mark-to-market accounting and of historical cost. So I think Rodney did a very good job to explain the framework. So how the mechanism should work here. Historical cost accounting produces no direct impact on bank balance sheet. So unrealized gains and losses do not impact bank's income statement and the balance sheet overall. Mark-to-market accounting is such that changes in the value of assets have a direct impact in the income statement of banks in the period in which the changes occur. And then securities can be held in different portfolios. So you have the held to maturity, also called as banking book, where historical cost accounting is applied, the trading book, which is mark-to-market, and the available for sale, which in the setting that is analyzed in the paper was mixed somehow. And the paper is very good, is very clever to use this change in the way sovereign bonds had to be accounted for in the securities portfolio. Between 2010 and 2018, they were at historical cost. Then in 2019, there was a change. So in the available for sale portfolio, sovereign bonds were accounted for with mark-to-market accounting. And then the public sector purchase program affects the value of bonds, and therefore this had a smaller effect in 2015 as fewer securities were mark-to-market, and the larger effect in 2019 where a larger share of sovereign bonds were marked to market. So I think the paper is very nice, is very rich and well executed. There are a lot of robustness checks. The topic is very interesting and at the crossroads of different literature. So accounting rules and bank behavior, and here there's a nice paper by Lawes and Lloyds 2010 that sets the stage about the potential effects of accounting regime of banks' behavior. The transmission of unconventional monetary policy, here there are many papers, but this is a nice addition, I think. A recent work following the Silicon Valley Bank default. So my discussion will mainly focus on the mechanism, then the proposal of the mixed accounting regime, and then, if time allows, a few comments on the specification and clarify some results. So the main comments I have are about the mechanism and the way the mechanism is presented. So I think that it would be very natural for this paper to show the impact of the PSPP on the income statement of banks. And I've shown here the exact state items that appear in the financial reporting framework of Italian banks, the so-called FINREP, that is observable. And these gain losses can affect capital. And for the case of gains, of course, they affect capital to the extent that they are not distributed to shareholders as dividends. Actually, this is similar to the effect shown by a paper by Acciaia and co-authors on the effect of the whatever it takes announcement by Mario Draghi. So the point there was that the announcement had the effect of reducing the sovereign yields, increasing the gains in the income statement of banks, and then pushing banks, in that case, especially banks with low capital, to lend more. And in that case, especially to weak borrowers. So to be more constructive here, I think that the paper could focus more on providing further evidence precisely on this mechanism. So first of all, it could show that actually more exposed banks experience an increase in the income from trading and from the revaluation of assets. Of course, this can be done both with the bank level regression and potentially just with the scatter plot. Secondly, it can also provide more evidence on the type of securities that are held in different portfolios. So, for example, are the securities that are put in the mark-to-market portfolio those with longer maturity, higher duration, potentially a different currency? Because in the case of the Eurozone debt crisis, for example, there was this issue of the redenomination risk. And the question here would be, are banks that are more exposed to mark-to-market accounting decide to expose them more to price fluctuations by placing in those portfolio precisely the securities that are more sensitive to price changes? And also, it would be helpful to provide more aggregate evidence, so more narrative on what happens. So, for example, these pictures from the ECB website shows the net buys in the asset purchase program that includes the PSPP. And actually, it is possible to see that in 2019, the net buys were very, very small. So the bulk of the net buys from the ECB was at the beginning of the program somehow. And this suggests that this was really an announcement effect. But then we would like to see something on the yields. And in this picture, I plotted the yield on Italian sovereign bond around the announcement that is used in the paper. You can see that indeed the yield went down a lot. Unfortunately, I'm just showing you monthly data, but daily data are basically showing the same dynamics. The point here is that the yield is starting to drop as early as June. Now, it is not easy to understand exactly what was driving the behavior of the yields here, but it would be nice if the paper could provide further evidence suggesting that really the announcement had a major effect on the drop in yields. And the same picture for the spreads between the Italian government 10-year government bond and the 10-year bond shows a similar dynamics. Okay, so there is a substantial drop, but the drop started in July, June. Okay, I think I have no more time. Yeah, so I will talk to Rodney afterwards with the other suggestions, my other comments. But in general, I like the paper a lot. And
all right, thank you very much to the organizers, Diana, for putting the paper on the program. It's a pleasure to be here, also a pleasure to speak in front of you, and I'm very happy that everybody sort of like stuck around until, even though it's almost lunchtime. The title of the paper is Liquidity Dependence and the Waxing and Waning of Central Bank Balance Sheets. It's a joint paper with Viral Acharya from NYU and Rahul Chauhan and Raghu Rajan, both from Chicago Booth. Oh, awesome. So the motivation of the question that how we started the paper was a relatively simple observation, right? So since the global financial crisis, there has been globally an unprecedented liquidity injection by central banks. So the ex-ante sort of like idea was that banks should have been flooded, or markets should have been flooded with liquidity. But then we saw these instances that occurred now a little bit regularly since 2019, such as the repo spike in September 19, the dash for cash in March 2020, the UK gilt turmoil in 2022, and then the most recent banking debacle around Silicon Valley Bank, that apparently banks have been more liquidity constrained than we should actually have expected given these liquidity injections, right? So the question then we were posing, is the kind of the central bank expansion or liquidity expansion that central banks have been doing and financial stability or instability for that matter, are those related? And the answer at the end of the day is definitely yes. And the next couple of minutes, I'd like to show you a little bit how we thought about this and how we tried to tease this out in the data. And I think last paper was a relatively nice, or not a relatively, a very nice example actually of a paper on quantitative easing, looking at the asset side of bank balance sheet, like portfolio rebalancing, this kind of capital strengthening channel, so to speak. What we're going to do is, following the theory work of Viral and Raghu, focus on the liability side. So how does central bank liquidity expansion impact the demandability of claims, so to speak, on the liability side on regular commercial banks? And specifically, we're going to look at the deposits as well as also credit lines that that the commercial banks are issuing. And the key insight is that quantitative easing is not only an expansion of central bank balance sheet, but it's also an expansion and also very much alteration of commercial bank balance sheets. And the reserves that central banks inject into the market are financed with demand deposits. And the two risks that might materialize and what we're going to focus on is, on the one hand, in the time series, that the uninsured demand deposits that are used to finance the reserves actually do not come down when the reserves come down. And the second risk is then the cross-section, that at the end, when the reserves actually come down, the reserves do not remain on the balance sheet of those banks that actually have a lot of the deposit at the end of the day, right? So that's some asymmetric development, so to speak, in how reserves and then deposits as well as credit lines develop. So very, very brief, sort of how should we think about quantitative easing and purchases of bonds? We can think about this on the one hand, buying bonds directly from bank balance sheet or buying bonds from the public market, and the impact is very different. In the case in which central banks purchase simply bonds from banks, we see here initial bank balance sheet condition, both in the Federal Reserve as well as the banking sector, as well as after the Fed has purchased the assets from the bank's balance sheet. effectively what is happening, the central bank buys treasury securities from the bank, so the assets are going to be reduced by $1, which is going to increase the central bank's treasury securities. And at the end of the day, the reserves are going into the bank balance sheets on the asset side, so it's going to increase by $1, and the liabilities of the central bank increases by $1, right? But this is just basically an accounting change. There's no change in the commercial bank balance sheets, right? So it's effectively an asset swap. But if the central bank, that is frequently being done, is purchasing the securities from the public non-bank sector, then the fact that the public sector cannot hold reserves, this results in a balance sheet expansion of the banks, because the public sector, so to speak, receives deposits in exchange for the treasury securities. They deposit the money with the banks. So the commercial bank's liabilities go up by 1, and they hold in turn reserves of +1 with the Federal Reserve, right? So as soon as the central bank or the Fed buys bonds from the market, it immediately results in a mechanical balance sheet expansion of the commercial banks, which is 1 by 1, something that we can actually also see in the data. But what we're going to look at are a couple of things that might actually come along with this balance sheet expansion, right? So first of all, we're going to ask, how does the Fed QE affect the size, deposit, and so-called demandability of the deposits in the banking sector? Specifically, we'll look at other demandable liabilities issued by banks. Specifically, we're going to look at credit lines. They also grow with reserves. And then what happens after QE is done in the post-QE as well as quantitative tightening period? Do these claims actually shrink at the same time when the reserves shrink? Where are these claims? Where are these claims to liquidity, such as deposits as well as credit lines in the cross-section of banks? Are they also there where the central bank liquidity is, or no? Which could be possibly a problem, because in the case that the claims are being needed, they need to fund them in the interbank market if liquidity is available. And effectively, then what's the consequences of financial stability? And the key result is quantitative tightening is not simply a reversal of quantitative easing. It's not just you give $1 into the market, you just take $1 out, but there are a couple of things that actually happen. So the quantitative easing is a growth of both on and off balance sheet demandable bank liabilities. When the reserve expands, there is an expansion on the commercial bank deposits, but it's specifically on the uninsured demand deposits. And we see that it's not only a one-on-one change, but it's also change in the maturity structure. Banks, because they now have more access and think about more continuous access to central bank liquidity, they make themselves more vulnerable by shortening the maturity of the deposits and by writing additional claims on liquidity through the issue of more and more credit lines. When quantitative tightening sets in, there's a hysteresis effect. There's no commensurate shrinkage of these liquidity claims, neither in the deposits nor in terms of these off-balance sheet credit lines. So in fact, some of these claims are actually growing in the phase after quantitative easing has actually ended. That means this, and this is what we mean with liquidity dependence. Banks make themselves more and more dependent on central bank liquidity by issuing more demandable claims when reserves actually grow, but that makes it more or less impossible for central banks to actually take out the liquidity from the market, and you actually see a more like a ratcheting up effect in terms of liquidity over time, and there's basically no real shrinkage of this liquidity. In effect, quantitative easing can then be this uphill task, and quantitative easing may less effective than envisioned, so it's not sort of So one point you could make, or the question they could raise at the end of the day, is given the kind of questionable effects or positive implications that quantitative easing has, but the relatively clear negative implications that we can actually show, is quantitative easing actually an effective or efficient tool to use by central bankers in the future. That is something that you could ask at the end of the day. So I'm going to show you now a couple of time series pictures how the different claims and reserves are going to develop. Some of that we've already seen in the first presentation. And then we go a little bit more into the cross-sectional test also to see actually is there what's actually changing, and can we kind of also see that there's some kind of a causal effect of an increase in reserves in what banks are actually doing. So that's the key empirical idea, at least of the paper. So what we have here is since 2008 and until 2023 is the development of the reserves as a percentage of GDP, and we have the different horizontal lines, which is a quantitative 1, 2, 3 period, the post-QE period, the start of quantitative tightening 1, the pandemic QE that starts here, and then the start of quantitative tightening 2 in 2021. And you can see here that, as we've seen before, there was basically no reserves before the financial crisis, and then the whole system became much more dependent on liquidity during the quantitative easing periods, and then this goes down during quantitative tightening, and then to a new level even in the pandemic QE period. If we now add the deposits in green, which is on the right horizontal axis, you can see that there's more or less a relative high correlation. When reserves go up, we see an increase in the deposits, and there's a specifically stark increase during the pandemic QE, and then deposits also come down during the quantitative tightening period. If we add now also credit lines also on the right-hand scale, you see it's a little bit less pronounced, but you can see also during quantitative easing, credit line issuances go up, and again during pandemic QE, there's a specific spike in that as well. If we change the scale a little bit and now put these sort of claims on liquidity, deposits, and credit lines as a function of the reserves, so expresses as a multiple of reserves, you can see that during quantitative easing, what we would expect, a massive increase in reserves. So of course, these ratios, both for credit lines, deposits, as well as uninsured demand deposits, are actually going down. But then in the post-QE quantitative tightening period, when the reserves are actually leaving the system, you see that it's suddenly increasing. So apparently the claims are not reduced to the same extent, and these ratios are actually going up, right? And then during pandemic QE, when the reserves actually go down, the ratios are of course falling again. If we do that and now split the deposits up into uninsured demandable or time, as well as insured demandable of time deposits, you can see that the most of the movement, what we observe, is actually coming from both the uninsured demand as well as also the uninsured time deposits, right? Our story is more about the uninsured deposits, but a possible question or concern could be that, okay, over time, it's not only the central bank liquidity that's actually entering the market, but there's also a lot of fiscal policy going on, and that could also at the same time impact this as well. What we do here, and now I'm going to deviate a little bit from the script that the discussant has, because this is not in the paper yet, but I only do this twice, and I'm going to say this clearly. This is one of those. What we do is we plot the change in the uninsured demandable deposits as well as the change in the insured demandable deposits on the change in reserves. We do this first of all for the full quarters that we have, and then we do this for the quarters where we take out the stimulus months. If we do that for the uninsured demand deposit, we see whatever you do, you see this positive slope. So if there is a change in reserves, there's an increase in the uninsured deposits, in the uninsured demand deposits. If we do this for the uninsured, for the insured deposits, if we take out the stimulus quarters, we get a negative correlation, which means that the change or the increase in the insured deposits is more driven by fiscal policies, while the change in uninsured deposits is more driven by the increase in the reserves through the liquidity issuances. Okay, so the empirical tests are both in the time series as well as in the cross section. We have first of all the implication of a change in the reserves on the quantities of the demandable claims as well as on the pricing. I'm not going to show you that for time reasons. And then we move into the panel tests and look at what is sort of the implication from reserves on quantities in terms of deposits as well as credit lines. Here we need an instrument for bank level reserves to claim some causality. And then what is the change in reserves on the price of liquidity, specifically the term spread and the deposit rates. To do that, we're going to need an instrument on the bank level reserves as well as deposits. I'm going to come to that as well. So in the time series, what we're going to do is relatively easy. We look at the change in the deposits or credit line as a function of a change in the reserves, as well as the lagged reserve. We do this in changes rather than levels because of stationary concerns as well as co-integration. If we do that, and we have here specifically our change in reserves here, as well as the change in the log reserves, as well as the change in the level of the reserves. And here we have in the log changes both in the deposit, the demand, the time deposit, the credit lines, and here the deposits, demand, time, and credit lines as a level changes. Doesn't really matter in what way we do it. The key results emerge that on the one hand, we see that asymmetric development and the time when demand deposits are increasing with reserves, the time deposits are actually shrinking, right? So there's a shift from time into demand deposits, which sort of emphasizes the maturity transformation that banks are doing away from longer term into shorter term, because of course they are less expensive. And if liquidity is abundantly available, then we can also decrease the cost by making them much more shorter term. So that's the interpretation. And here you can see that both in the demandable deposit as well as in credit lines, you see that impact and change in reserves increases both the demandable claims in deposits as well as credit lines. And here this change in reserve and change in regular deposit, that's the one. This is the more or less one-to-one mechanical increase that you would expect overall if you have an increase in reserves on the commercial bank deposits. All right. If we do that, and it's a dependent variable as a dependent variable, now look at the uninsured and insured deposits and uninsured demand deposits. You can see here that it's specifically the uninsured demand deposits that are changing when the reserves are going up. Right, so those are going up, and the impact on the uninsured one is on the insured ones. Is somewhat less pronounced. What we're going to do then is we're going to move away from the time deposits to, from the time series to the panel test, simply because we have, of course, a limited time period available, so a limited number of quarters available. So it's relatively difficult to figure out what are differences between different quantitative easing, tightening periods. So there's basically a lack of power. So we're moving on to do a test in the cross section of banks. But then, of course, there might be some question about, okay, how exogenous are the changes in reserve? Because, of course, if banks get into trouble and have some problems themselves, they might actually find it difficult to raise liquidity in the market. So we might expect actually positive correlation here as well. So this is why we need to find instruments on the bank level to get at kind of a reserve beta. What we're going to do here, and this is the second time I'm deviating from the script, because in the script we have one instrument, now we have two instruments. The first instrument is exactly the same, but we add a second one for reasons become obvious in a second. So the question is how can we approximate this? And we do this, okay, given that the kind of the most, at least the assumption that the Federal Reserve balance sheet expansion is sort of exogenous to the individual bank. So we're trying to exploit that and calculate a reserve beta that effectively says, if the central bank expands its balance sheet, then if we look at the past 4 quarters, sort of like take up of reserves of individual banks, then that's kind of, that's basically the proportion that they would also take in the current increase in the reserves. It's kind of similar to a shift share approach that we're trying to do, right? So we look at what is the growth in the aggregate reserves of the Fed balance sheet now, and then we multiply this, what is the bank's share of the aggregate reserves in the past 4 quarters, and attribute that as an exogenous increase in the reserves on the individual bank's balance sheet. The second one is relatively similar. We're going to use the not only the increase in the reserves, but also the increase in the overall balance sheet of the Fed, and multiply this with the individual banks' reserves over the past 4 quarters. And the idea that if we do that, this would be the most exogenous way in which we could look at how much of the reserves of the increase in reserves is actually going onto the balance sheet of each individual bank. If we do that, then this is how much time do I still have? 2 minutes. 2 minutes. Okay, then all right. If we do that, then we see that the change in reserves is basically increasing uninsured demand deposits during the overall time period, but specifically during the QE1 to Q3 and pandemic QE, as well as the QE1 and QE3 period. But in the QT period, so to speak, there's no effect at all, right? So there's no shrinkage, so there's an insignificant effect. So even while reserves are decreasing, the uninsured deposits, demand deposits are not changing at all. And similarly, if we look at the deposit spreads as a price of liquidity, so to speak, you see that if there is an increase in reserves, we actually observe a decrease in the deposit spread, specifically on the 3, 12, as well as 24 months period. This is during QE. If we look at this during QP, during the quantitative tightening period, again, you won't see an increase in the reserves, so they're not actually changing, they're not making the maturity longer term or making it more attractive for people to deposits by increasing the spread. We do a bunch of other tests, and I need to highlight the most important ones in order to stay in time. So we're looking at if banks actually reduce or increase the deposit maturity, they have to have some market power. So we do that and look at where's the concentration or the deposit concentration the largest. We see that the effects are also largest there. We're looking at, is this actually a worthwhile exercise for banks? But we see that there's basically no or relatively little to be gained from that exercise in terms of like net income increase for banks. And the last thing that we're actually looking at is, okay, how does this actually play out? We look at the COVID shock and look at what is sort of the implication for banks which have the largest exposure to these additional claims. They are the ones who actually experience the largest decrease in stock returns in March 2020. And also experience the largest drawdowns. So the risks materialize also by an increase in drawdown activity from firms at that time. And we're also looking at the implication in during the SVB crisis. So you see this is not coming out that nicely, but you should see an increase in the deposits during the quantitative easing period. And then when there's a quantitative tightening and the rate hikes at the same time, you already saw in 2022 a substantial decline in the deposits, which basically is the liquidity risk that materializes then for the banks. You see this not only for SVB, you can see this also in the aggregate, looking at all the individual banks. So what does it mean? And then I'm done, is if reserves are actually, if demand is exogenous, right? If the increase in reserve is basically only increasing deposits one by one, then it might actually be kind of stabilizing. But if there's new claims on liquidity being created, then the implication of an increase in reserves on the price of liquidity is something that might be different than expected. So let me close here and then look forward to the discussion. Oops.
Of the paper, there are some new results. There is a lot of interest. Regarding the effects of quantitative easing policies, the interaction of quantitative easing policies with the other instruments of monetary policy, and the existence of some unintended consequences of monetary policy. In this direction, this paper is trying to understand whether quantitative easing may increase the financial risk, the liquidity risk, especially of some institutions. So the question is whether QE may contribute to the financial risk, especially they were considering the how the QE may have contributed to the financial stress in those two periods. Basically, the main results, they have many results. I am just going to summarize some of those results and share some comments. The main results is that there is some liquidity dependence. So when there is an expansion in the balance sheet of the Federal Reserve, then there is an increment in demand deposits, credit lines, but time deposits may decrease. However, when there is a contraction in the size of the balance sheet of the Federal Reserve, this process is not reversed. So there is this persistence in the expansion, there is this asymmetry in the expansion, but then in the contraction, we don't observe the contraction at the same speed, and therefore there may be some liquidity risks, especially for some financial institutions. They document that it is connected with the price of liquidity. So the claims on liquidity are going to be connected with the price of liquidity. And there is also this panel analysis that is going into the same direction, that is documenting that the expansion of the balance sheet of the Federal Reserve is going to the direction of an expansion in demand deposits, credit lines, but time deposits are going down, and we don't have the reversal of this process. So there is also an increment in asymmetry in the dispersion of the aggregate liquidity claims over the availability of reserves and other assets, because in particular the banks with weaker capital positions are going to be the ones who are going to expand relatively more their liquidity risk. So this may contribute to the concentration of financial risk in some institutions. Now, okay. So one of the main points of the paper is that QE may has been a fundamental cause of those liquidity tensions, and at least it has been a significant contributor to those financial tensions. Okay, regarding the policy implications, the idea is that the QE may attenuate the effect of some transmission channels of some transmission channels of monetary policy. In particular, the portfolio rebalancing channel may be affected by this change in the claims, in the liquidity claims. And in addition to that, this could have a negative effect on financial stability. So main policy implications is that it may be a good idea to reconsider the incorporation of some liquidity regulations when you are implementing QE, and try to eliminate the constraints regarding the interbank liquidity in the QT period. In particular, in the paper, they suggest some state contingent tolerance. Okay, so those are the main results, or just a summary of the results. Here are some of my comments. Regarding the time series analysis, I am not so sure about the evolution of term deposits, because we know that term deposits have this secular trend that may be associated with interest rates. Therefore, I think that sorry. So we don't have more problem with the So regarding the time series analysis, I believe that you may want to consider some controls. It may also be interesting to consider, of course, you may have on that, and I would like to hear from you some other dynamic structure. So whether you want to test other dynamic structures there, but in particular, I understand that this time series analysis may be expanded. Regarding the panel analysis, I find it very interesting, very good. I am just going to discuss one instrument, and what I think is that here it may be interesting to further discuss the time fixed effects. What may be the relevant time fixed effects? Why? Because it is going to be important for policy and for model building. What may be those other time fixed effects? To discuss some other control variables, you are doing that in part in the paper, but some of those other control variables may be relevant again for policy and model building. So those fixed effects. To consider other dynamic structures, but there is an asymmetry. And it may be a good idea to try to explore that asymmetry. Here in this analysis, there are no band fixed effects, so it may be also relevant, I am not sure. And then regarding credit lines, I would say that for the aggregate economy, credit lines are relatively stable. But for the panel analysis, I think that credit lines may be more relevant for some particular institutions. The fluctuations in credit lines are going to be more relevant than for the whole economy. Okay, so regarding the concentration of risk, I would say whether those policies go